I'm going to start this week with the central bank. Wednesday, we got the summary of economic projections, and no good news on any of the projections, nothing in the right direction. Let's look at change in real GDP, the December projection versus where we are in March. For 2025, 2.1 downgraded to 1.7, 2026, 2% for real GDP downgraded to 1.8, and 2027 downgraded to 1.8. This line here is important to understand that. Changes in SEP largely due to trade policy. Unemployment rate just slightly higher for 2025, but no changes in 2026, 2027, considering the plan for laying off government employees seems rather light. PCE inflation higher, and same with core PCE inflation higher for 2025. Core, no change in 2026, 2027, but slight increase on headline for 2026. The forecast that they have, change in real GDP 1.7, if we look at where Atlanta Fed is, they're basically in line with the consensus, the blue chip consensus, whereas GDP now is negative 1.8 for Q1. This is all of 2025, mind you. This is just Q1, but they're kind of in line right now where the blue chip consensus is. When we look at rates, no change in rates. So you have a drop, forecasting for 2025, a drop in real GDP, an increase in unemployment, and an increase in inflation. That is towards a stagflationary outcome. Now, I don't know if that is to influence the administration by saying, look at what we think is going to happen if you continue on this path. Balance sheet runoff was another big thing. Down to $5 billion from $25 billion. The cap on MBS runoff is $35 billion, but only about $15 billion runs off each month because prepayments are very, very low. Who's going to prepay a 3% mortgage just to get into a 6.5% mortgage, right? So prepayments are very low. As rates drop, especially the 10-year, the prepayments may speed up and the runoff on those might be quicker, but it's still well under the $35 billion cap. So we're going from 25 to 5 billion, combined with about the 15 billion on MBS right now. You got about a runoff of 20 billion a month, which is on a balance sheet of over 6 trillion in assets. That's really, really slow. Down to 5 billion, but no selling of MBS to buy treasuries just yet. However, this may force their hand if this continues. Foreigners are net sellers of U.S. treasuries, largely central banks. November, 34.4 billion. December, almost 50 billion. January, another 13 billion. And this is after 15 months of increases. The selling is continuing, and from central banks. So if you get tariffs across the board in the flavor that the U.S. administration has been putting them out lately, if we take their threats to be real statements and not just jockeying for position, you will end up diverting a bunch of trade away from the U.S. You'll push Canada closer to Europe, and both Canada and Europe closer to China. China yesterday has opened up the possibility of restoring diplomatic, I wouldn't say diplomatic ties, but diplomatic relations with Canada. That's been some icy relationship for a while. But it's just pushing other countries closer together, ex-US. If that's the case, central banks don't need to hold as many US dollars because the amount of trade with the US that the country does is lower. You don't need to support the banking system with a lot of US dollars. So if I'll just draw a pie chart here and say that here is US dollars that a particular country needs because it's holding its foreign reserves. The central bank holds foreign reserves fairly in proportion to the currencies in which it trades in. So if the U.S. is, let's say, 30% of trade, it'll tend to hold U.S. dollars to support that. Well, if trade is diverted and U.S. is now only 20% of trade, it doesn't need all those U.S. dollars. It may need more euro. So it would sell some of its treasuries to reduce the holding, its foreign reserves, the holdings of U.S. dollars, and increase those on the euro. So that would put selling pressure on the U.S. dollar, selling pressure on treasuries, and buying pressure on the euro. So the euro would tend to appreciate. In this scenario, the euro would appreciate against the USD, and yields in the U.S. would increase, meaning bond prices would drop. That could be an explanation of why the Fed decided to move from 25 to 5 billion on runoff. That gives an incremental $20 billion worth of purchasing of bonds that otherwise wouldn't have happened. Instead of letting 25 billion run off and only letting 5, the other 20 has to be reinvested back into treasuries. That might be to offset potentially what they see as a rebalancing of foreign reserves by central banks, because this last 3 months has been largely central banks already. Besant had pointed out every $300 billion in cuts in government spending is about 1% of GDP. And I don't know what the last published number is, but they're quite a distance away from 300 billion. They're quite a distance away from the 1 trillion or 2 trillion they claim they could find. It just really isn't there. Also, every 300 billion in aggregate demand will have the same effect. If 300 billion cut in government spending means recipients won't be receiving that 300 billion, it would be the same thing as dropping aggregate demand by 300 billion, would have the same effect. Just the non-tariff retaliation across different countries is probably 300 billion on its own. Just the drop in tourism from Canada to the U.S., the removal of American alcohol off liquor store shelves, the focus of Canadians to buy Canadian instead of American makes up a significant amount. And you have this happening in different countries in the world. So it would be hard to see how this consensus will play out in Q1. I seem to think the Atlanta Fed has it more right than wrong, and that Q1 is going to print a fairly ugly number, but you're not going to get that till the end of April. So you have April 2nd reciprocal tariffs will not be informed by this number. Only at the end of April will you get this number. Even the March jobs report doesn't come out till April 4th, so that's not available as well. So in the data, we haven't really seen the real impact of all of this just yet, because when we get the data, it hasn't included a full month of any of this stuff yet. And April 2nd, we're expecting reciprocal tariffs. And I've just listed the amount of risk associated with that. You have US dollar risk, yield curve risk, and obviously the big one, market risk. This is all April 2nd. Based on what we've seen so far, you would seem to think, and especially with the rhetoric, that this is going to be, what is it being called, the day of liberation for the U.S., that it sounds like it's going to be this big across-the-board tariffs on everybody, everywhere, on anything that moves. If any country has any kind of tariff, they're going to be hit with a reciprocal tariff. And this is what it's sounding like, which would be very damaging to the U.S. dollar. Depending, well, I shouldn't say damaging. I guess it depends on what side you're standing on. If you think the U.S. dollar is too strong and a weaker U.S. dollar can help a lot, then it will be beneficial. Bearish for the U.S. dollar, which may be beneficial for the U.S., but you have dollar risk in there. So if you're a foreign holder of U.S. assets and the U.S. dollar decreases even if the asset price increases, the change in just the US dollar could take away your gains when you bring that money back into pounds, euros, Australian dollars, etc. So you have that risk, and that might be what was going on over here, is a belief that the US dollar was too strong and was probably more than likely going to weaken. Let's rebalance away from a strong US dollar now. Well, you have dollar risk coming up. If it is across the board tariffs on a number of countries and a tariff war opened up on multiple fronts, that will weaken the US dollar. You have yield curve risk as well, because if you have a dollar dropping and you've had central banks taking this action, if you have a tariff war and trade is going to be redirected around the US, and basically with not having a choice but to do that, you're going to need fewer, or central banks around the world will need to hold fewer US dollars. You could get Treasury selling and a rise in the long end of the curve. You have yield curve risk in here, and the market is not going to take any of this well. So you have market risk. So April 2nd has the potential to be bloody across currencies, US currency, US Treasuries, and US equities. Just a big red day depending on what we can expect. Based on what we've seen, I don't know if we would suddenly wake up and say, no, there'll be complete rationality here. All of that was theater and show. This is the real deal. Or the thinking that I'm on is that while the policies are sound, you have a group of people who have no idea how to implement any of these, and they're just figuring it out as they go. Like somebody had said, I don't remember where I heard this, I think it was on Bloomberg, they appear to be building the airplane as they're flying it. That even the faithful, the MAGA crowd, the base, have to be thinking.
You're such fucking dopes. I love you, but you are not serious people.
Now, that being said, Bloomberg has a story. You need a subscription to Bloomberg to get it. About some people inside the administration saying, no, this time is different. That these are going to be far more targeted. Now, if that's the case, if it is just a matter of saying, okay, tariffs exist for all sorts of reasons. Heck, we're even thinking of putting tariffs on to raise revenue, so why would we think that no other country would do the same thing? So, okay, tariffs do exist. One thing that we can agree on is the U.S. does have some of the lowest tariffs in the world. If you look on average across its trade and you weight it all, it does have some of the lowest tariffs in the world. And there are some countries who use tariffs to protect their domestic industries, maybe protect them a little too much. That the U.S. doesn't reciprocate that way. So that, sure, you can sell your product in our country and there is no tariff. So there is no friction on your products coming into our country, but our companies can't have the same benefit in your country. That by the time you put a tariff on, the price that your citizens pay for it is so high they choose not to pay for it. So sales from American companies into certain countries are lower because of that. Well, that to me does seem unfair, that if you're going to charge your citizens 70% tax to buy my country's products, I should stop your products from entering the country by putting 70% on and see how you like it. It could force other countries to lower their tariffs. That would be on the side of the good outcome. As opposed to having the tariff in place, other countries may begin to remove their tariffs or dramatically lower their tariffs to a level they can live with. And if it is more targeted in that sense, and targeted towards fairness and not targeted towards threatening and bullying and an attempt to extract all value out of the rest of the world and bring it to the US. That could be good. So there is some reports out now that the administration is going to take a far more targeted approach. Based on the action we've seen over the last month, how can you be sitting in that administration and say, yeah, this is really working out great? I mean, you got to be looking at it and saying, okay, that's a bloody mess. We can't continue with that. And all of them have market exposure. All of them have dollar risk and yield curve risk and market risk exposure. And all of them are probably bleeding in their portfolios, but they have to put on a happy face and say everything is great. Musk is hurting a lot. I mean, he's even gotten the president to do an infomercial. He's gotten Howard Lutnick to go on TV and shill Tesla shares. Everyone, investment advice, everyone should buy this stuff. Even Tesla had an all-hands meeting, and Musk encouraged everyone, don't sell your shares, hold on to your shares. This is a guy that's worried. So when you surround yourself with a bunch of billionaires and you cause market turmoil, those billionaires are going to show up and say, do you think maybe there's another way? We have that going for us. If we're going to be in the market, at least those people around him are self-interested enough to say, hey, what can we do about the market here? Can't we find a way through this and save all of our portfolios at the same time? So maybe you'll get something more market-friendly that still attempts to accomplish the goal that they're trying to achieve in a way where that guy can read his victory speech on April 2nd that he wrote 8 months ago. It's the same victory speech, the one. So that is a big risk event day. I do have SPY short position against an IWM long position because small caps have been beaten up a lot. Continuing to short them is like kicking someone when they're down. And small caps tend to have far more domestic exposure, whereas large caps have far more international exposure. And if April 2nd is yet more belligerence, then the companies that tend to export more will be affected more. You'd want to be short SPY, I think. But if it is rational and reasonable, you could get a significant relief rally on April 2nd, even a rally leading into it. If the rumor is that it's going to be more reasonable. I hope there is no rally leading into April 2nd. If there is, the Trump administration may misinterpret that rally to be about support for how they've done things so far. So I hope the red ink continues on to April 2nd to force their hand to say, okay, they really, really don't like what we're doing. And all of the billionaires around him say, dude, I mean, you got to be hurting too. I mean, come on. So I'm probably going to reduce my SPY short position going into April 2nd. And I'm going to position for a rally on the belief that they cannot possibly be immune to what has been going on, that on the belief that these billionaires are still, even though they have billions and they're still rich, are still self-interested, saying, this is hurting us, it must be hurting everyone, because of course that's how rich people think. And hopefully we get something rational. Every week I look for a theme. What am I going to talk about this week? I'm really tired of talking about tariffs every single week, but unfortunately, every single week, what is the big risk event every single week? It's what that guy says. It's what he screams out on Truth Social, and it's what he says in the Oval Office as he sits there holding his press conferences without standing, which is odd. Usually you stand to command the room, but he just sits there huddled behind his desk. It would be nice to get back to a government that's boring, because that's what it should be. We shouldn't even notice it going on. So anyways, April 2nd. For those of you in Canada, I have some good news for you. And this is coming from a Liberal government. Good news for successful people from a Liberal government. You're not going to believe this. I didn't believe it when I saw it. I thought, oh my God, are we going to actually have a pivot back to the center from the Liberals? Are we going to have a Liberal leader in the style of the 70s and 80s and 90s Liberal leader? A fiscal conservative but social Liberal? He canceled the capital gains tax increase. Off the table, gone, it's gone. The carbon tax, gone. The capital gains increase, gone. It's still just a 50% inclusion, not 66%. So he is slowly taking away the bullets that Poilievre had. Poilievre was basically running on we are not Trudeau, and you know what? That would have gotten a majority hands down. That's why I didn't want Trudeau leaving, because I thought if he leaves, the Liberals might have a chance of winning again. NDP is basically gone to zero, which I think is a good thing. And it looks like it might be a dead heat between the Conservatives and the Liberals. And this last move positions Carney as a more classical Liberal, which is the kind of leader you want. Somebody in the center, somebody who is fiscally conservative but socially liberal, without forcing you to participate in everybody's belief system. So it's a fight now. It looks like it's a fair fight. Let's see what happens. We have an election in Canada that has been called for April 28th. I'll be in, if it's April 28th, that must mean I'm in Madrid at that time. Let's have a look at our yield curve. Money market rates, almost no movement here. A little bit on the 1 year, 5 basis points out. And small move on the capital market curve. It is, we have some bullish action there. Yields dropping a little bit. But looking week over week hides the volatility we had all week. TLT should not have this kind of volatility, but it's behaving like a risk asset, not a safe haven asset. Next FOMC meeting is 45 days away. Only 45 days away. Expectation here is heavily on no move. Was 72% last week, now 87%. And for 25 basis point cut, dropping from roughly a quarter down to 12.9, cut in half. Minutes from this meeting we get in 17 days. But with the press conference and the number of Fed speakers you have until the minutes are released, usually you pretty much know what you're going to find in the minutes, that there's nothing really surprising where I got to see what they said about this. Usually it's pretty much all out there. Durable goods in 3 days. Mexico in interest rate decision in 4 days. The final look at Q4 GDP for the US in 4 days, and US PCE in 5 days. So there's a risk event here. Also on Friday, we get the preliminary look at February GDP for Canada. Get that in 5 days. Reverse repo, 200 billion. Reserves still elevated, 3.4 trillion. So there is, I've been asked this a lot, where do you get the 2.5 trillion? That's my estimate of where ample reserves are, that you want to get to 2.5 trillion with the combination of the reverse repo and reserves. So 1.1 trillion runoff, but now we've dropped, I put it at 25 billion a month. It's more around 20, but we'll assume that maybe some of the MBS have sped up a bit, or that will speed up if there is more pressure on the 10-year. If the 10-year keeps coming down under 4%, you'd probably get a faster runoff on some of the MBS. But 45 months, I don't know that this is really worth watching anymore. At some point within the next year, I assume they'll just end balance sheet runoff. The bigger question is, when are you going to start moving out of MBS and into the longer end of the curve to help the Treasury out? Because that is what they want to see. Oh, and by the way, if you are watching Truth Social, Trump has already started truthing about interest rates, about the Fed. Fed should be cutting rates. Fed should be cutting rates and supporting our agenda that has already begun. So that might be to put pressure on Powell so that Bessent can step in and say, look, I can shield you from a bit, but you got to help me out here. Start lowering your MBS and start buying the longer end of the curve. We got to get rates down to get the funding cost down on the rollover of debt, rather than continually rolling over the short debt. Push it out to the long end of the curve. But, come on, Jay, let's give me a 10-year around 3.65 so I can start issuing around there. Now, I don't know if it goes to 3.65, but I'm sure they have a 3.5 to 3.75 range in their head. I mean, that's the range I would have in my head. You got over $2 trillion of dry powder to get that done without increasing the size of your balance sheet. And if you're worried about your profitability, take a look at your income statement over the last couple of years. You're bleeding money anyways, right? What are they bleeding out? What was their loss last year? They just had their audit. $114 billion, I think, was how much the Fed lost last year. So, if you're worried about what your income statement looks like, a little late for that. I see that as the next move between the Treasury and the Fed is eyeballing that MBS, saying, look, we're on the same page here. We can all solve the problem, and you don't want my orange boss screaming down your neck, and he's gonna start. So maybe that was an opening gambit on forcing Powell's hand on that. But Powell is not a dictator. He's part of a committee. And for the balance sheet runoff, going from 25 billion treasuries to 5 billion, you had a dissenter. So you have to get the committee on board to move MBS, to move out of MBS and into treasuries. You had one dissenter on just lowering the pace of runoff on treasuries. If you can't get the committee on board, well, again, Powell's not a dictator. He's not going to be able to get that done. He has to convince the committee to vote for that. But I think this will be boring. What's the point of watching that? I think now it's a matter of, what kind of language are we going to start to see around getting that MBS out and into the Treasury, into U.S. Treasuries. Yield curve slope on the 2 to 10 years still positive, both Canada and the U.S. That is just a capital market curve. The money market to capital market, you want to call that inverted, you want to call it flattish, right? It's not really inverted, but it is flattish. In Canada, it is upward sloping. In the U.S., we still have an inversion from the money market to capital market curve. Not really the best for banks. If you get upward sloping, that becomes very good for banks as the short rate drops. The net interest margin spread for banks increases. And if you can decrease a lot of regulation for banks so that they don't have to hold the level of capital that they're holding, they can start making more loans. Right now, you probably have books that are limited by capital adequacy ratios. If you relax those, if they start making more loans, that would be beneficial for the banking sector. So if we're looking for some place in the future that could benefit from policies, or at least stated policies, banking sector would be one of them, especially if you can get this to start dropping. Looking at Fed funds futures, pricing in 71 basis points just to the end of the year. I've gone to the January Fed fund futures because the last meeting is December, so January would price in the December effect. 3.62. 71 basis points lower than what they are. 3 and 6. I'm saying, no, okay. I don't know that I would bet against that and say, no, they say 2, there'll only be 2. I'm going to short the Fed Fund futures. My bias would be to be long, but we'll see what happens April 2nd. You get this across the board tariff stuff that we've seen. You get more of that kind of tact in tariffs, then yeah, I think you're going to get more than 3 because you are definitely going to break a lot of stuff. If we think about, I like the way Bill Maher had put it, if you think about the bull in the China shop with Trump being the bull, the U.S. is the China shop. All it's going to do is hurt the U.S. badly. Well, not all, but it primarily is going to hurt the U.S. if he continues on, or the administration continues on this way. April 2nd could be a pivot point. If it is 3 and 6, okay, that sounds reasonable. 1 and 8, where we were late last year, did not look reasonable at all. But 3 and 6, maybe. But if it's across the board, then I think more than 3 and 6. TLT had a okay week, up 0.59. SPX up 0.51 week over weekend. We are going to get some Fed speak coming out this week. Real rates, all lower. Look at that on the 5-year, under 1.5, 1.49 now. The 7-year, 1.3. The 10-year, under 2%. Only the 20 and the 30-year above 2%. You do have a more steeply upward sloping real curve than you do a nominal curve. Break-even rates, not much of a movement here. Slightly higher, a couple basis points across the board. Mortgage rate, 30-year, 6.67. You've got to get that much lower. Lennar had their earnings on Friday, and on the conference call, they did point to that. They pointed to housing prices haven't moderated very much, and the 30-year fixed rate mortgage is still elevated between 6.5 and 7, which is not a good place to be. So they are suggesting that the housing market in the U.S. is going to be weaker for longer. You got to get the 10-year down so that you can get the mortgage rate down. I'm sure you hear my devices going off in the back. It's just, this is what happens in the Apple ecosystem, is you get one notification and 87 devices decide to lighten up and say, hey, you got a notification. It's like, yeah, Apple, I get it. You think, with as smart as they are, they would say, listen, there's 87, I don't have 87 devices, but I got 1, 2, 3, 4, it's 6 devices all in proximity, 7, that you'd think that they'd say, okay, listen, if we're going to do a notification, why not just do it on one device? Do we really have to do it on all 7? Right? But nope, here we are. OAS have sort of reversed course a bit. From the expansion. You did have tightening over the last week on the OAS, and again, I would look to April 2nd for this as well. If you do have rationality coming back in on the reciprocal tariffs, you could see further tightening on these spreads. The news this week, or at least the noise in the housing sector, comes from Bill Pulte. He's the grandson of the founder of Pulte Homes. PHM is their ticker. He is the director of FHFA, the Federal Home Finance Administration. He fired the CEO of Freddie, Diana Reid, and a bunch of other senior executives, and he also cut staff at FHFA. He's also appointed himself board chair of Fannie and Freddie. Is this a move towards privatization? There is some talk about getting those private. Bill Ackman is pushing to have those privatized because, of course, it would benefit the American people. It would benefit him because he has large positions in it. We don't know if it would benefit the American people or not yet, but if you believe in small government, then privatizing these would make sense. However, the purpose of these organizations was to provide a more efficient mortgage market. If the free market doesn't do it on its own, then that's where you would have a role for government to step in. This is, kind of shocking here. 2,900 people are employed by FHFA, and over a 1 week period, only 49 of them actually showed up at the office. At least if we are going to take the statements out of these offices as true. That they report that only 49 people out of 2,900 showed up to work. So there is large cuts expected in this space, and the increase in this headcount happened after the pandemic. So they would just be returning to pre-pandemic levels. So you can look for some cuts on that number as well. Bessent has also said the government stake in these two GSEs, even if they are privatized, the government would still have a stake in them, that the government stake could become part of the sovereign wealth fund. So it looks like it's on that pathway, based on some of the moves that are being made, getting rid of more bureaucratic CEOs, perhaps, and looking more for a market-oriented CEO in time, cutting the staff dramatically. Preparing it for an IPO. The Trump administration, this is one of the beliefs, is that they would lean towards it as well. So things are moving. So let's draw a set of eyes and let's make sure we keep. There we go. And let's make sure we keep our eyes on this over time. Let's have a look at SPY for the forward 4-quarter operating earnings. 269.78 last week, 270.36. They come down, but this is not really coming down. This is just adjustments week over week. I think it most likely will have to come down. Earnings will start somewhere around the second week of April. And keep in mind, April 2nd, we have the reciprocal tariffs. Closing SPX 56.67. Still gives us a very rich 21 times forward earnings. By most measures, the S&P 500 is still very richly valued. Even though it's come down from just under 23 to 21, it's still at the higher end of its valuation over history, up from 20.86, and that's with earnings coming down. Is because you had a rebound here on the S&P 500. All-time high, 612.30, February 9th, down 7.9% on that. Small caps hurting even more. IWM down 16% off its high, and IJR down almost 17% off of its high. I am now long small caps. I'm long both IWM and IJR. I had sold puts and they were put to me, but I am short SPY. Short SPY because it is only down 8% versus double that for the small caps, and because tariffs would hurt large caps more than it would hurt small caps, because of where large caps get a lot of their revenue internationally. Small caps tend to have more domestic exposure, but I have explained that position and what I'm going to do going into April 2nd. Still lots of implied volatility here in terms of the percentile. 13-week at the 75th percentile. Over the last 52 weeks at the 89th percentile. Down from last week, but this is typically how it works. As you go down, IV drops. As you start to recover, IV then decreases. Earnings this week, they just can't agree. I just don't know why they all can't just get on the same page. Monday, you have McCormick, Tuesday, Wednesday, Paychex, Dollar Tree, and Cintas, and there's some confusion between LSEG and Sector Spider about when Lululemon is going to report. LSEG has them Thursday, Sector Spider has them Friday morning, so Lululemon is in there somewhere, and Walgreens is in there as well. There's not much commentary I'm going to add to SPY. that I haven't already said on the first screen. I think we're all waiting to see what happens April 2nd. I think the big event April 2nd is not necessarily what will happen, just that it has happened and now we know it, and it's not as if we're all waiting around for what will it be. We will know what it will be, and then we can move in that direction. If you are on Discord, you will notice we do have a channel for the market outlook. I'm just going to draw a screen here, and I'm going to put it in 3. And down here, all the menus, all the channels, you'll see one for market outlook. And when you click on that one, the latest market outlook shows up at the top of the list. And if you click on that, over here is the comment section for each of the market outlooks. If you click on this one, the comment section changes to this one. I'm slowly encouraging the comment section to show up there instead of under the video on YouTube. It shows up here. Well, right now the only people who can comment on this one here on Discord are those who are on the Discord server. We're up to 2,200 applied level subscribers right now, with a lot of charter holders, level 3 CFA candidates, and quite a few with masters in finance. It is an intelligent place to be. The level of conversation is absolutely amazing. People in the industry that are doing work on certain things, just being able to comment on what they know and the insight that they have on certain things is just incredible. I will, for the Q&A video that I do, be prioritizing the comments here first, and then if that's enough, we'll just leave it at that, and I'll eventually phase out the comments on YouTube. But I'll prioritize these comments first in the video, then I'll go to YouTube and answer those. What you can expect over the next 60 to 90 days is the comment section under this video on YouTube will eventually be closed, so that there will be no comments allowed. All the comments will happen here. So what do you do if you're a YouTube subscriber and you do want to ask questions, but you're not an applied level subscriber and you don't really feel like doing that? Just go to markmeldrum.com. I'm just going to shorten it to MM, but it's markmeldrum.com. You can register for free, and you will have access to the level 1 2018, I think it's a 2019 CFA content. You're not writing the exam, so you don't need the 2025 content, but the level 1 content there will get you knowledgeable very quickly. If you want to be on Discord, you have to be here, and I will give you, you'll get a notification sometime in the next, I'd say starting in 30 days from now, we'll start putting notifications on the site for anyone that has a free account. You will have the A1 role. An A1 role allows you to view this channel, and only this channel. You can't see all the other stuff because it's for applied level subscribers, but you can view this and you can view the comment section, but you cannot comment. There'll be a process, it's automated, where you can demonstrate your credentials, because you might be a university graduate and have been in the industry for 5 years and be considered an expert on our site. If you demonstrate that you have the gravitas, the background, then we give you a higher role and you can start commenting as well, and you are part of this particular channel's community, but not the whole thing. For the rest of you who don't want to register for free, then you'd still have the market outlook, but it would be in a shortened version. It wouldn't be the longer version. It would be a shortened version, and there'd be no comment section. I'm eventually just going to move it all onto Discord. So it's not difficult. mm.com, free. FREE, free. I'm not asking you for anything here, not at all. I do check how many people have registered for free from time to time. It is elevated, so I do know that some people are heading over there. The other thing is our app. for the applied level. I'm having a separate app made for that. It will allow downloading of the market outlook into the app for offline viewing, because I have been asked for that quite a bit, is how can we get this offline? And it will have background play, which means if you turn off, you start the market outlook, turn off your device, it keeps playing in the background. You don't have to keep it on all the time. So somebody, quite a few times, not just somebody, but quite a few times saying, why don't I make this into a podcast? Well, what I do is very visual. It's hard to put it in a podcast, but there you go. That now turns it into a podcast, because you can download it to your device, hit play, and then you don't have to keep the device on, and it'll just keep playing in the background. You cannot be on the app unless you're on Discord, because you're going to need a Discord username to get into the app. And you cannot get into the app unless you're on mm.com, even for free, because you're going to need an login to get in. So to get into the app, you need both a Discord username and an login. And that is how we do our audit to make sure everyone on Discord is in fact on our site. It's an ecosystem, man. You see what I'm trying to do here? So make sure you get that done, because I'd say by mid-June, the comment section on the market outlook here will be turned off, and the market outlook will be shorter. It'll consist of only 2 screens, so the big stories around it that I try to find each week won't be there. And if you are interested in the applied level, what follows is a section from the positions video I put up every week. This past week, I looked at FedEx, looked at its conference call. It had a big drop in price, but that doesn't mean there isn't an opportunity there for a trade or an investment. So I outlined several different positions that can be taken, including an in-the-money short strangle on FedEx that has a really nice return and a wide spread on its break-evens. So that follows, just so that you can see sort of what they see, and they get that, well, yesterday was a day before, but usually 2 days before the market outlook hits, the positions video hits. So what follows is FedEx, a nice sort of trade setup on FedEx, and then that'll be the end of it for this week. All right, this is from the press release, and this is from the presentation slide. FedEx is revising its fiscal 2025 revenue, earnings, and capital spending forecasts, and now expects the following. This is not the first time they've lowered their forecasts. Revenue flat to slightly down year over year compared to the prior forecast of approximately flat. And when they forecasted approximately flat, that was a lowering as well. Diluted EPS, well, we can skip over this. Let's go to this one. 18 to 18.60 per share after excluding costs related to business optimization initiatives, international regulatory and legacy FedEx Ground legal matters, and the planned spin-off of FedEx Freight. So that is after all of that, 18 to 18.60 compared to 19 to 20. That's a fairly big downgrade. As far as tariffs go, this was asked by one of the analysts in the Q&A. They said it's reflected in the forecast. The 18 to 18.60 is reflected in the forecasts. And one comment was related to customers. Customers are expected to raise their prices to their consumers, or have already raised their prices. I think it's worth listening to the commentary on that.
As far as kind of how customers are planning, we're having a lot of conversation about being able to move the network as they require, and of course we are able to do that. We are looking at making sure all of our pricing tools are very dynamic. We've been very pleased with that. So from our ability to respond to customers, most customers have not made any major changes to date because it's really quite difficult to be able to set up additional inventory in another country or move manufacturing. These are things that happen over months and years, not over weeks. I would say, to the point on inflation, that we are talking to a lot of customers who are anticipating that they will increase prices or already have. So thematically, that is one conversation that we've heard a lot from.
Here are the Q3 25 results. Revenue 22.2, 2% year over year. That's over Q3 of 24, resulting in 12% year over year increase in adjusted operating income and 17% increase in adjusted diluted EPS. So if you're guiding lower, even 1% on revenue, it's going to be a significantly larger drop in operating income and EPS because of the operating leverage. Their midpoint here was 1950. This was for the year, and now they're guiding lower. This is Q3 done. So the bigger hit's going to come in Q4. We are at a midpoint of 1830, right? So you can see how bad Q4 would be. That's down $1.20, 7-8%, and they're just guiding flat to slightly down versus flat. They pay a dividend, $1.38 per quarter, $5.52 per year. Given the closing price of $230.33, is 2.39%. It's not that exciting. Very low IV, 25.4%. However, we do have an effective federal funds rate of 4.33%. So if we're thinking about generating the stock, generating the dividend, and maybe attempting to get the cash rate on it with a covered call on a leap, we can get that. 52-week low closing, 230.33, down 6.5% on Friday alone. Given the low growth year over year, that this is a low growth business at this point, it's more of a cash generator. At this point, 12.6 times the earnings multiple. Friday's close puts them down almost 26% off their 52-week high. And I don't think last mile delivery is going away. So it's at this point, this is more of an infrastructure network asset. They do suggest two things here. Industrial economy remains weak. This is the big one. Global trade policies are adding uncertainty to demand. If on April 2nd you get much more intelligent tariffs, you could get some upside to the fourth quarter for FedEx. As they said on their call, the tariffs, they've already put it in their forecast. So that's already there. It's not as if we can expect that to get worse, but it could get better. And they have corrected in price to reflect a lower earnings. Their multiple 12.6 sitting at 230. They have been as low in 2022. They were as low as $150 a share. So before we get too excited about it, let's look at some potential trade setups. What we can do is just think about, well, if we're getting a 2.39% dividend, can we triple it? What if I said if you bought it, you can get a 7.2% yield on this from holding it? You would think FedEx, it's not going away. It's eventually going to come back. So 7.2, I'm getting paid to hold it. We'd be long plus a short strangle. This is not straddle now. This is a strangle. We'd want to triple the dividend. We're getting $1.38 per quarter. Let's think about the put and the call quarterly. If you divide that into the put and the call, we'd try to get $1.38 on the put, $1.38 on the call. That would be 3 dividends we're getting per quarter. They did pay in March, so if we go to June, the 195 puts got $1.34, the 270 calls got $1.25. This is what our quarterly income would be, and as the price of FedEx changes, each quarter we would set the call and put such that we are trying to match the dividend on the call and match the dividend on the put as best we can. But you still have risk in that it can be put to you at 195. If it's called at 270 over the next quarter. We're at 230. And do I think that they're going to get called away at 270 in the next quarter? Not really. So I feel fairly confident by selling the call. But they have been as low as 150, so I might not feel as confident selling the put. So what I can do is I could just concentrate all the premium on the call. I can go long plus a call, a covered call for June. The 260 call has 245 in it. So instead of 259, you're getting 245. So quarterly, if I look for calls that double the dividend, I can get that done. But I have to, I have quarterly risk. What if FedEx drops from 230 to 195 and forces me to sell a 220 call? Right now, I'm selling calls below my break-even price. That's not always an attractive place to be, because we still have such a high Fed funds rate. Remember now, the calls are centered around the forward price. So if we look at the price of FedEx, the forward curve looks like this because it would be upward sloping. If you go out a year, the calls, the 50 delta calls, are centered around the forward price, not the current spot price. So we do have a lift of 4.33% helping us out on that. What can we get if we use leaps? Let's go out 1 year to March 2026, and let's say you were long 100 shares, you bought it at 230.33. The $240 call is $24.55. Over the year, you get a dividend of 5.52. The combination of these two is 13.06%. If FedEx is called away from you, it would be called away at 240. You still get the difference between 230.33 and 240. 17.25% return if called away from you. You have 24.55 protecting you on the downside without having the other put in place, without another 100 shares being put to you at 195. This would give you a break even somewhere around 206 by doing this, and you're getting this. You get this anyways. Right, and if it fell to 206 over the course of the next year, you would not lose anything. You'd not make anything. The unrealized loss you'd have on your position would be offset by the gain that you have, but you would have a taxable gain over here. Since you sold a call, it should just lower your average price. This would not be income, whereas this would be the dividend that you would have to declare. Can we get a little bit? Can we get a little bit better? Let's say we give up a little bit of return. Can we get a better profile? And this is a beautiful thing about options, is that you can structure whatever return you want. You can determine the return you would like, and you can use options to get that return. You can set your return and risk profile, as opposed to just buying 100 shares and saying, well, I hope it goes up. Let's start with, well, what return are you comfortable with? And let's use the options to get that return, and let's lower your risk as much as possible. Look at this one down here. Let's say we did a leap, but did the 200 short straddle. So we're going to buy 100 shares, and we're going to sell the 200 call and the 200 put. We're going to get $59.05 for doing that. $59.05 for selling the 200, because when you sell the 200 call, the stock's already at 230. You're going to get $30 of intrinsic value right away. Let me draw that out, because this is kind of a neat little one here. Let's just take this out of the. It didn't work. Okay, let's go to the other layer. I'm using Sketchbook, and it does this stuff in layers. So let's get rid of this. Notice if it is called away from you here, it'll be called away at $200, but we did get paid $59 for the call and the put. If we paid $230.55 along with the dividend and along with what we got paid for the short straddle, we'd get 12.36% if it's called away from us. pays 2.4% on the dividend. So we basically got about 5 times that dividend. So we've increased the dividend by 5 times. If it's not called from us, or sorry, if it is called from us, it's the same as getting a 500% increase in the dividend. If it's not called from us, clearly it's going to be under $200. What's our break even? Because we got 59.05 for that on 200. $140. So if it is put to us at $200, it's an effective put price of $140 at that point. So here is FedEx all the way down to $230, right? And we're going to go out, let's do it this way. We're going to go out a year, and we're going to use the 200s. We're going to sell a put, and we're going to sell a call. When we sell the call out 1 year, keep in mind that this is the forward curve. The higher the interest rate, the higher the forward curve. The lower the interest rate, the lower the forward curve. So because we have such a nice high interest rate right now, the forward curve is steep. 200, this is what we're going to get. So you can see this is the intrinsic value. There's the time value that we're going to get, because that is where the center of the forward curve would be. So we get all of that, which means we're basically buying FedEx at $200 a share, because we're paying $230, but we are selling everything above $200. So we're selling some of the intrinsic value. So it continues to drop to $200. We don't lose anything. If it ends at $200, we don't lose any of that, because we sold that amount. So it gives us a lot of downside protection. And it gives us a nice yield, 12.36. So this is sort of a combo that you put in your portfolio, and you simply just forget about it, and if it goes up, if it eventually gets called away from you, it's a 12.36% return for something fairly safe. And if it does get put to you, you have downside protection all the way to $140. So even with something like FedEx, even with something like this, when you combine it with options and interesting strategies, you can architect the type of return along with the risk profile that you would want. And that's the power of combining your underlying with options. It turns what otherwise would be an uninteresting stock, $230 for a 2.4% return with a low growth company, into something that, well, hang on a second, on a very low risk profile, I can get 12.36%. Suddenly, I would take that, right?